Folks, Season 2, Episode 19, and with me is Movement Mortgage. I have James Gay and Mark Halvorsen to my left. We're going to be talking about the market this year with all the volatility in the Treasury. We're going to be talking about improving your personal position for the best loan possible. We're going to be talking about how rates were affected and how the market did in terms of mortgage rates through 2008 to 2012 and how they're going to continue from 2025 and beyond. This is an episode you do not want to miss if you are looking to get a loan in the next 12 months. Thanks for watching. Episode 19, listeners, we are back, and this is going to be a new segment, some updates on the mortgage industry, and I have two gentlemen to my left. These are veterans of the industry, James Gay and Mark Halvorsen. How are you guys? Movement Mortgage in the house.
Feeling good. I feel like he just called us old, though.
No, I said veterans.
He called you old.
Is that what it is? Okay. Yeah. I am the older one, right?
Yeah.
James did bring me a cool hat.
I did bring him hat and a shirt that he you know, it's not a banana costume, but it does look like
we have some nice swag.
If he does put that on, I'm curious how tight it's going to be. I was talking about the shirt, not the hat, but
I'll rip that thing.
Okay.
Large. Yeah. But I do have a hat.
Yeah. Do you believe this guy says he wears a 2X?
Yeah. Is the Ozempic working? I look skinny.
You do look thinner.
Couch potato is definitely working, I guess.
Couch potato.
Yeah, you're on a couch. Yeah.
Vertical.
I spend a lot of time on a couch.
Yeah, I like it.
Good. So, how are we doing now?
Doing good. Doing good.
All right, tell everybody who you are, how long you've been in this industry, and about a little bit about your mortgage brokerage.
You want to let the elder go first?
Yeah.
Okay.
My
name is James Gay. Work for Movement Mortgage. Been there for a couple years. I'm not the OG like Mark, but I've been in the mortgage business since 2004. So I've been around for a little while. Went through the crisis of 08. You know, the fun that we've had since then. So Movement has been around in Augusta for how long, Mark?
Since 2015.
Okay.
Coming up on 10 years. 10 years in May.
You've been in the game since 2015?
So I've been in the mortgage industry since 2013, mid of 2013. Opened up the branch of Movement in May of 2015.
15. Okay. So where were you before that?
I was at Element Funding.
Element Funding.
Yeah. And
no
for a very, no. Nope. Yeah.
You expired.
Yeah. Because of me. They're like, going out of business. Now then, I was at Wells Fargo for a year, Element Funding for about 8 months, and then Movement.
Okay.
Took the chance.
Okay. How did you find Movement Mortgage?
So they found me. Basically, they were trying, you know, in our world to get recruited. I mean, I did like coming to different brokerages, and I was honestly probably on my way out. I was like, I'm just going to go back into coaching and teaching. Okay. And then I just decided to talk to David Massey, who was the regional at the time, and he was just telling me, he was like, hey, just give us a year. Okay. Give us a year. You open it up. We'll let you recruit people. And I'm like, oh, now we're talking my thing. I'm like, oh, recruiting is fun.
Okay.
So, it's not like sports recruiting. I found that out, but at the same time, it's been great. Like I opened it up. They gave me the keys and
bonuses.
For certain people, yes.
Okay.
Yeah.
Okay.
Yeah, for James, absolutely.
But now James is the manager of the brokerage.
Yes.
You decided you like sales way better.
Yeah. Yeah. Managing is not it. There's a lot of time that goes into that. And with my 4 kids and everything I got going on, and just probably organization overall, like James came in and it was good. Like it was an awesome conversation to have when he told me, he was like, hey, I'm coming to Movement. I'm like, heck yeah, let's do it.
Let's do it. Were you at Colony Bank before?
No, I worked for a company called Bank South previously,
right.
From 2018 to 23, and then prior to that, we were with a State Bank. Used to be, they got bought by Cadence Bank, and prior to that, it was First Bank, and
okay,
so it kind of goes back to 2004.
First Bank, is that out of Thompson?
It used to be McDuffie County Bank. That's
County.
Right. Mm-hmm.
Oh yeah, I got a quick little. I was in McDuffie County yesterday.
Yeah.
And
it's a good spot.
Where we listen to this little didgeridoo here. We're up in McDuffie County, and there's this little house. I got $1,000 finder fee. I don't know what the heck I'm doing up in McDuffie County. We're dealing with this, but it's kind of a fun treasure hunt. We're like, why is there a bank putting a padlock on this house in the middle of nowhere, right in McDuffie County. There's no liens, there's no mortgage. There's a security deed secured debt from 2002 for $1,290 from First Community Bank.
Yeah.
Now owned by Queensboro.
Probably not worth even riding out and put a padlock on the door, but
Queensboro put a padlock on the door. There's a guy out there from the mortgage company. We're like, this is 2025. What are we doing? I paid off that deed secured debt, apparently.
Yeah.
Jeez.
so someone went through the archives and they're repossessing the house. I don't know. It's a whole thing. It's
For like $1,200.
$1,200.
Wow.
I don't know. I think it's a whole thing. It's a whole thing. Anyways, it's more of a goose chase, and I'm just enjoying the treasure hunt and figuring this thing out. But I think we figured it out.
Right.
So we're working on it.
Do you have people that drive to McDuffie County normally for you?
No, it's me.
Okay.
I did.
I noticed that you just gave your phone off to someone. I don't have someone like that.
Yes, you do.
No.
Yeah, it's two people.
It's two people.
It's not true. They don't like it when I give them that. Mainly because of the recruiting and the spam calls.
The spam calls are awful.
Yeah.
We got to figure that out. That's $1 million idea.
Yeah.
Google screen. Call someone with a Google screen. It's like, ew, I don't want to do this.
Right.
Hang up. So, all right. The mortgage market right now. We had a little bit of a dip a few weeks ago. Kind of popped back up.
April 4th was a good day.
April 4th was a very good day.
For a couple hours.
For a few hours.
Yeah.
Right. And and what kind of rates were we seeing on April 4th? And why did they dip? Why did they dip down to where they dipped to? What did they dip down to? And why did they pop back up?
I think it's everything to do with these trade wars and the uncertainty of it. So, when the trade, I'm not going to go too deep with it, but ultimately, when they did this Liberation Day and the tariffs and the trade wars, a lot of folks pulled money from the bond market. And in return, what they did was, from the stock market rather, and put it into the bond market. So when you have more money in the bond market, it pushes that 10-year treasury bond down. And so it made the rates come down kind of accordingly. So we probably got down in the mid 5s on government loans and the low 6s on conforming conventional loans. So, it was pretty good for a few hours there. And so with the uncertainty of the tariffs and the back and forth with China, other countries, Canada, Mexico, it was when you have uncertainty in the market, stock market's not going to do well. The bond market didn't do well. So I think they put the 90-day pause, then we're taking it off, then we're putting it on. And it's just the market doesn't like uncertainty. So, it is
a market. I think a lot of people don't understand that the mortgage rates are a free and open market.
Mm-hmm. Correct. They trade 10-year bond trades, pretty much 24/7, but the stock market doesn't like uncertainty, and they usually will rush over to the bond market. But when you have, Trump, the White House wanted to fire Jerome Powell, that creates uncertainty because if the White House controls the Fed and the bond market, you don't have that separation of power, and ultimately, really the only thing that's worthwhile. That's why you saw gold to kind of take off for a certain period, because if the USD goes down and he controls the Fed, then ultimately the bond's kind of wasted, and uncertainty goes, rates go higher, et cetera. So like this morning, ADP numbers came out and job numbers weren't great, which winds up being great for rates, bad for the stock market. You saw the 10 years already coming back down a little bit, which is good for us.
Okay.
Ultimately, but then, traders like to trade. And a lot of times right now we're trading off of just conversations, which is not great. So when you're going in and trading, the GDP numbers came out right after that. Now we kind of reversed immediately. So the little bit of gain that we would have because of the dollar being less, then it's a trading just to trade right now. Kind of give you an idea on the forecast. I think that was 115,000 jobs, but only 65 was the reality. So because they had a huge miss, that's the reason why the bond market got better, because more people are moving money from the stock market over to the bonds.
Okay. We hear in extreme volatility right now. Okay. And depending on the type of volatility, it can be good or bad. And it can have volatility in the mortgage market. And, we love this question. I'm curious about waiting until 2026.
Sure.
I think rates are going to go down. And what's so interesting about just that perspective of things is the longer I've been in this industry, the more it's just become more clear that the projections and the timing and all of that is just sort of it's a losing battle. It feels like it just feels like a losing battle to me. I can't think of a single time where I said, "Man, I wish I had waited on engaging in any sort of real estate." Right. I can't think of a single time.
Right.
I can only think of, man, I'm really glad we pulled the trigger when we did. You know, we didn't maybe pull it at the perfect moment, but heck, I'm looking at I felt at the time like, oh man, 6.3 on my house was rough. And I've had Mark's heard this. I have an open bounty. As soon as someone can get me a 5.3, you go ahead and just, here's my information. You go ahead and just pull the trigger. First one to tell me when to sign a piece of paper will get the refi, because I'm not convinced at all we will see that or much lower than that anytime soon. I just want to get a whole, percentage knocked off my mortgage rate.
Right.
And, is that sort of, do we share the same sentiment here? Is there, if someone asks you, hey, James, hey, Mark, how, if I wanted to try and time the mortgage market, what is my best educated way of doing so?
Don't try to time it.
Yeah, don't try to time it.
Okay.
There's no way you can time it. And I always tell this a lot of conversations I have, because I'd say I'd love to be one of the experts in this market that we pay money to, to subscribe to and like listen. All right, hey, you guys are geniuses in this, and hey, this is a projection, and I'll try to relay that. Seems like it's opposite all the time. Seems like whatever they're telling us is opposite. Hey, you should float this rate. Don't lock it yet. If you're over 30 days out from your closing date, let's say you're under contract, and you have 45 days till closing. Oh yeah, let's wait to lock. I'm like, okay. So I'm from the experts. I'm sitting here telling them, hey, all right, let's just kind of wait. Let's see what happens. And then complete opposite. It's like, oh crud. It's now we're 0.25% higher than where we were before. Or, it's so hard to predict that's what you have. You can't be an overpromise on deliver in our business. You just have to say, if you like the rate, if you're comfortable with this, I know it's risk reward, but this is comfortable for you. I would say lock it in, because it's not going to make this huge, crazy dip. I mean, like we say, April 4th did, but the next week it was up 3/4%. Right. So
I was presented an interesting loan product the other day. I want y'all to comment on this, because this is my perspective on this loan. It's a 10-year adjustable rate mortgage. And I was asked about it and what my thoughts were. And I said, I haven't been in the industry for half of that time. So I really don't know the pros and cons of this product.
Are you referring to that it's like a 10-year arm, is locked for 10 years, and then it can adjust afterward, or?
Correct.
Okay.
Correct. It's a 10-year arm. You get a very below current, like standard market rate.
Yeah.
I think at the time it was like 5.5 for a conventional.
Right.
It's a conventional 10-year arm at 5.5%.
Sure.
I was looking at it for myself, and I was like,
it really depends on,
everyone's
different, right? So it's really dependent on what your situation is. Some of the folks that do come in for industry, arms are coming back. For a while there, a lot of folks weren't really pushing arm products because the rates weren't as good as fixed. And a lot of it had to do with the industry understands that rates will lower at some point, and people will refinance. And so in order to get those refinances, if you're in an arm, it may not be a benefit to you because rates will be lower in a year, 2 years, just going back with how folks are saying that, rates will get better. But if you're in that 10-year, if you're looking at a 5-year or 7-year arm, but your plans are you're coming in, you're going to be at base or, one of these industries for 3 years, maybe a 5-year arm is perfect for you. Because what if you get extended a year, et cetera? So kind of gives you that buffer if the rates are going to adjust. But unless the
you're going
rate,
to sell in a couple of years.
Correct. The average is 5 to 7 years on a time period. It's actually been probably shorter in the last few years with rates. But I think that it really just comes down to what someone is comfortable with. If someone's not getting teased with a lower interest rate and doesn't fully understand that rate can adjust, and if we're in a market that we were back in 23 and 24, where the rates were higher, that those rates and the adjustable rates are coming out, adjusting a point, 2 points higher.
Okay.
It really just depends on, that may put them in a worse financial situation.
Yeah, that hurt the market.
Right.
Yeah.
So, and let's pretend we have a bunch of fifth graders listening to this. I'd be impressed if there was one. But an ARM is an adjustable rate mortgage. That adjustable rate mortgage, after the 10-year period, it can go up or down.
Correct.
Depending on the market. How often can that adjust?
Depends on the product
the
and what
product.
you're doing, but it could be every year.
Okay.
And it could go up a point. It could go up, there's multiple, depends on what the caps are and the, all the different variables of that product. So it's hard to speak on it until I knew the full, description of that product to tell you what it can and can't adjust to.
Like you were saying, we didn't see like a big gap. A lot of people were asking about adjustable rates. Like if it was a 6.25 or 6.375 on your 30-year fix that you had at that time, arms are pretty much right there. There wasn't a huge benefit to it at all.
Right.
But if
If
you got a 10-year 5.5, it's just like, hey, read the fine print. Like you got to look at it and say, hey, is there prepayment penalties? What is it on? Can I refinance in 2 years and then go from there? If it did drop to 5,
we haven't seen many. It's so interesting. We on our standard GR in South Carolina net to seller sheet. They ask you to. And we're calculating these. When they're asking you to
Are you
calculate
laughing because
these,
you don't read the contracts or?
Because I did not read the part about a prepayment penalty, and there may be a prepayment penalty on something we're looking at.
Right.
Anyways, but you don't really see those we don't really see those a lot anymore on these balance sheets. I've never seen. When are you gonna? What kind of loans typically have these prepayment penalties?
There's not many that have prepayment penalty anymore, since a lot of that got, basically removed, and that's probably one of the biggest things we get questioned, because I think it was popular prior to 2008.
Okay.
There were prepayment penalties. I remember my first mortgage was an FHA, probably 1999. And shut up. And knew that's what you were going to go with. But anyway, so it had a prepayment penalty on it, and they usually gave you a little less interest rate for having a prepayment penalty on it. But I don't know that any that have prepayment penalties on there.
Maybe some balloons or some special products, but
probably some short-term
standard
type products. Yeah.
Okay.
You don't see it on FHA or conventionals.
Okay. And I want to go back talking about when trying to time the market. Just a lot of folks, you got to keep in mind, rates have been higher, right? Mm-hmm. And we have seen some dips, and I do think we will lower in rates. I think the data that I read last week was year to date and even year over year, we're 13% on purchase contracts right now, higher.
Okay.
So with higher rates and looking at where we are and what the outcome of with the uncertainty of these tariffs, being up 13% is pretty. I mean, that's a good number in my opinion for year over year and year to date. Just think about, I think we've done, 4 or 5 million in sales nationally in real estate. That's a good market personally. So market's still moving. So if you're trying to time it and wait, if we're increasing in value, 4 to 5% each year, you're going to lose. And if rates drop down to 6% or even a full point, I think a consumer is going to lose with paying more. We go back to where we were in 2020 and 21. The sellers weren't having to pay seller concessions. You were having to waive appraisal and repairs. My opinion is, if you're ready to buy now, because if you're comfortable with the payment, you're actually able to get closing costs. You're actually able to get repairs completed. Done. If rates drop, great, you're already in your house. You can refinance at that point if it's beneficial, dropping a point like you were mentioned for your personal house. I think you get a better opportunity to buy a house now, because there's a lot of houses that folks were in that 2 to 4 range that had appraisal gaps, or they had no repairs. They got no closing costs. It costs you more money when that time comes. So I think we'll get there. I think if rates go to 6%, we can add probably 1 million more purchase nationally. And I think it's just going to be a good time, even more time to buy. But do you want to be in that rat race that, I love this house, but it's got 10 offers on it. They're not going to give you contingency offers. I mean, it's going to be in a different world than we are currently.
That right before Masters Week, 2 weeks leading to Masters Week, when we had that little bit of a dip in the mortgage rates, if someone wants a good preview of what life was like, it was the first time in a long time. I think we went, Abby Grace, 2 weeks? 2 weeks without a single new buyer contract. And we haven't done that in a long time. Probably over a year now. We went with 2 weeks, and it wasn't like we weren't putting in offers. We had few people looking, and I think we had 3 or 4 people we were working with, and we were getting beat out. I was like, we don't. What is this? We wrote we have one contract right now with a $5,000 appraisal contingency, and I haven't seen that in a long time.
I've had a few recently have come in with the appraisal gap back in it, meaning that if it appraises less, then they're having to overpay to get the property. And some of these prices on properties, I personally buy and sell property. I'm seeing houses that we make offers on, and I'm like, I wouldn't buy it for that. I still got to remodel it, and it's selling for top dollar without a new roof on it, new windows, HVAC issues. So it's, I think we're already getting to that point with the rates coming down. Imagine how it's going to be if we're just a half point lower in rate. It's going to be great for us and great for the sellers. It's just going to be, you're going to have to pick and choose on your buyers. And, I had one that I made an offer on. They said, "Hey, I need you to write a letter to the seller." I'm like, they're not going to take my deal if I I'm not buying this as a primary residence. So it's going to be interesting to see how things go.
I want to make money on your property. Yeah. Please sell it to me.
Yeah.
Here's my puppy.
That's right. That's right.
Look how cute my puppy is. The letter to the seller on an investment property.
Nice.
Look at my realtor, Matt Kelly, and his awesome hat. You should let me buy his house.
Hat.
That's right.
Look at this thing.
Yeah.
We got awesome hats here.
Yeah.
It's actually, I think it's a pretty good, it's starting to feel a little more comfortable in my head. I on my purpose.
It doesn't look comfortable.
It's like 2 more snaps. Yeah, I think you need 2
I purposely didn't change the snap count on the back.
Yeah.
Okay.
I just wanted, he gave it to me like this, and it almost is working.
It's kind of a new thing. I mean, wearing it high.
Yeah, the sticker stays on too.
Yeah, sticker has to stay on.
Sticker stays on.
Do you keep all stickers on hats?
No, just movement.
I don't really wear hats.
Yeah, he does.
I'm balding. I'm trying to get as much use out of this hair as I
golf,
possibly
you don't wear
can.
hats. I didn't think about that. Every time we play golf, you don't wear hats.
Y'all call what y'all do is golf? I don't call it golf.
Called whack.
Yeah, there you go. That's what it is.
Walking land. Yeah. Shot 9-9 at River Club the other day. It was great.
I have a unique set of skills. It's just doesn't include golf.
We're equally terrible at golf, and I appreciate that.
The equal respect.
We could talk about when Mark and I play golf if you want to talk about that.
Hey, back to the market.
Back to the market. All right. So, consumer confidence right now, we're at, and there's a bunch of consumer confidence indexes. Consumer confidence had, dipped a little bit. It seemed naturally over the winter time. And you look at these different polls and stuff, and consumer confidence is increasing a little bit, which is good. James, you went through the real nasty stuff. And Mark, you got into it kind of on the tail end of the nasty stuff, but even with 2013 is when it was coming out of the refi boom. So I was coming in thinking I was going to be part of the refi boom. Right.
Like just
there was a refi boom in 2012, 2011.
Oh yeah. All those HARP refinances you could refinance from that because all the rates were super high coming out of 2008, and so it was like boom, and it got down to like the 3s or 4s. And right when I came in, it was like, oh, you can be fine. You can just call people and refinance them. You'll make tons of money. I'm like, yes, let's do it. Day I step foot, and they're like, rates just shot up. And I'm like, oh crud. So
I got to call 2 people to make a sale now.
Yep. Calling people in like Seattle, Washington. Hey, you want to refinance your home? Who are you? I'm like, I don't know.
This has been my whole view on things that what could really mess with property values. And I look at insurance. Really, we got that tort reform in Georgia finally, but there's always this thing I point to, and it's a really extreme case. But we were in San Diego, San Diego, and there's these multi-million-dollar houses, and on the cliff looking over this bay, talking like $50 million properties. Beautiful. Well, there's a fault line. It's 2 tectonic plates that meet, and one plate is made out of a certain stone, and one plate's made out of another type of stone. Well, one stone has been found to erode, and one of the houses fell off into the ocean. This was, maybe 10 years ago or so. Well, that entire line of houses, the city basically gave them 50 years to remove the homes. They're no longer insured, and you can go buy one of them now for like $13 million. But people were paying $50 million for them, but now they're worth 13.
Hmm.
You know, when insurance is not, when a home cannot be insured, you cannot get a loan on the home. And now you're dealing with cash only, if that. And of course, I don't anticipate a total like insurance is never going to insure a product like they're always going to do, but it can get very expensive.
Mhm.
And when you're spending more on insurance, you can't spend as much on the mortgage, and you have to consider that in your monthly payment. And that's
Right.
what consumers are always looking at, is their monthly payment. So, you know, let's say we just have a steep drop in affordability because of insurance. Okay. You know, James, going through and navigating this market in Augusta, and this is what I always tell people as well, is in Augusta, because of our industry, we do not see the ebbs and flows based on the numbers I've seen from 2008 through 2012. We did not do what other markets did.
No, I mean, go back to 2008. We were never considered a declining market, even in 2008. So we were close, but ultimately, if you have 2 quarters in a row of decline, then we would have been considered a declining market. So,
and real quick, we were already freaking out at 2008 because we thought we were losing Fort Gordon.
correct.
Mhm.
So we were already freaking out
Right.
here, like 2006, 2007.
Right.
Okay.
And so take Fort Gordon out of it. If we did have decline in sales, you know, or values in 2 quarters in a row, we would have been considered a declining market. So like the PMI companies or private mortgage insurance companies rate each county same way. So Atlanta was a declining market. You know, obviously a lot of folks, a lot more population. Here, we've always been kind of insulated between all our different industries and such that we've had. We've done real well with it. You know, kind of, if you fast forward to now, you have more, you know, we had a over an abundance back in 2008 of homes. People were building, assuming people were going to purchase. And so you had a lot of land, et cetera. And so we had some builders, big box builders come in town, built some property, square footages were lower, and that kind of helped new homes, you know, pick up a little bit. But they were really the leader of it, the resale. We did have some value issues back in 2008 for a while. So it took a while to get, you know, the values of the properties coming back up. And really, we never saw a huge surge of you know, values really until 2020. You know, you think about it, 2020, you know, the fear was we're all going to die. You know, that was the fear that we had.
Yeah.
People are going out and buying homes at a fast, alarming rate. You know, the national was, you know, I'm not trying to, you know, a lot of folks and friends passed away with COVID, but I'm not trying to, you know, not shed light on that. My point is that people were fear, but working from home, the whole world changed. You can work remotely, you can work from home. Let's go buy this house. Rates are lower. They weren't worried about it as much as, you know, that they are now. You know, people were worried that, you know, with the government, you know, not wanting to, we had Doge and the government slowing and cutting jobs. You know, we're kind of going back to where we had 07, you know, 08, am I going to lose my job, et cetera. So I don't think that there are certain sectors that have issues with it, but we're still pretty insulated, you know, with, you know, how Fort Gordon is, Fort Eisenhower is, and that, you know, the medical side of it, the college, you know, we've got really good industries with, you know, Southern Company, Plant Vogel and SRNS, you know, we've got good structure here, and we have had that for a while. So I do think that there's going to be certain sectors that lose their jobs, I'm sure. I just don't think we're going to have it as a scale as that we had it probably back then. And the difference too is we don't have all these crazy products. You got to keep in mind, we had no income loans, stated income loans. You know, there was companies that were giving people, you could state your income, and they may have been the drive-through person at McDonald's.
They're still out there. Those loan products still out there.
Correct, but you know they're not
being used.
They're not being overstated like they were previously. You know, we have bank statement loans. You know, there are folks that don't want to claim their taxes, and rightfully so, understand that they don't want to pay the IRS part of their income, and so they, you know, write everything off that they're allowed to do regarding what our IRS allows them to do. But it doesn't equate to where they're able to purchase a house, but they have steady income coming in, deposits into their bank account. So you could still buy a property, you know, without having proof of it on the IRS. Now you're going to pay more because you're, that there are certain investors that would purchase that. And so you can't go to Fannie Freddie and do that same product. So
that's what limits the ability to really push those type of loans too, is the investor backing and the type of investors you have to now work with for those types of loans. Correct.
Is
that really what's put the bind on it? Right. We're not able to do some of these funky loan products because you have a tougher time finding the investors for it now.
Yeah, they're out there. I don't know that there's any no income, no verification type loan.
Mm-hmm.
There's got to be some sort of verification. Even the bank statement loans. I mean, they're easy loans as long as you've got regular deposits coming in as steady, and then there's a factor we use because they still have some capital expenditures every month that they have to spend, but. It's really kind of designed for the folks that, do write off a pretty good bit because the IRS allows you to do so.
Mm-hmm.
They just don't want to pay the IRS, and some of them are legitimate, some of them probably are not. It just depends on, the situation. So we don't look at tax returns when we know we have that situation, and we just look at the bank statements and try to go from that matter.
Okay.
So.
Yeah, my OnlyFans is starting to pick up a little bit.
Really?
So I'm trying to find some creative financing for that. Well,
I subscribed.
Is that something y'all can help me with?
I've subscribed.
You subscribed?
I'm trying to help out.
You're my first one, actually.
Yeah, I know.
One and only.
One and only.
Just big
one
supporter.
and only fans.
One and only.
One and only fan.
Yeah.
One and only fan. Yep.
We're gonna. I Blanchard Marketing said no. I wanted to do a subscription model called Only Houses.
Oh, jeez.
You get access to only my houses. That's a big thing right now. Is these exclusive listings.
Mm-hmm.
Compass and national news. They're not really in our market, but that's something we're watching. Is an exclusive brokerage only. So if you want a Blanchard and Calhoun house, if you want a if you work with us, then you get access to our exclusive listing, our only houses.
Yeah, that makes sense.
Yeah, and then you could who say we can't charge $12.99 a month to have access to our only houses, But anyways, I can't do that bit. I thought about it though. I want you to know I am a little bit creative.
I'm glad you pitched it. At least put it out there.
Had to pitch it.
I mean,
so what you're saying is if the market does expand like we expect it to do with the lower interest rates picking up, and you would do it in exclusivity to have access to only Matt Kelly homes or et cetera.
I wouldn't personally do it because it's.
You're going to
I know
alienate
we're half
yourself.
joking here, but it's my opinion on the matter is it's very anti-consumer.
Sure.
And we just love to get sued over anti-consumer stuff. So, I just don't even I'm tired of the lawsuits, quite frankly.
How's the buyer commission incentive for the agent affected, or has it had any effect?
I'm making more money. I'm not, they what they wanted to do is they want us to have conversations about it.
Right.
And I'm very good about having conversations and demonstrating value and showing, hey, here, you want to work with me as a buyer. If you want me to be your buyer agent, I have a process to, really, really figure out how to get you a better deal on, a better deal. And, there's always this weird, it's always sat a little weird with me with the, I'm getting paid by the seller out of the seller's proceeds.
Right.
So, it's always felt like a little bit of a conflict of interest, but it's what we've been taught. And there's a fantastic reason why we have that model. There is I can go on a 30-minute history lesson, but we're getting close on time. But there's a fantastic reason we have the system we do. But if my buyer is seeing the value and willing to pay me, I have a lot of take a lot of joy in helping win, tens of thousands of dollars. I think we probably have 2 or 3 repair addendums out for our buyer agents right now that are 10,000+ in repairs. Yeah.
I've seen them firsthand.
So yeah,
It's impressive.
Yeah, we get a lot done for them. And I talk when I speak to our sellers. I'm like, we're experimenting with this. It's a conversation. You don't have to pay a buyer's agent. I think a good buyer's agent brings a lot of value to a seller indirectly through the expectation setting and through just making sure these contracts are airtight and a very anxiety-ridden buyer, which is this process is a very anxiety-driven process. Buying a home sucks.
Right.
Having a good advocate on your side just to say, hey, it's going to be okay. I think has a lot of value to a seller. So once again, a lot of more conversation is being forced to be had, and anyone who's
I think it's a
worth the
good thing.
dang in this industry can handle those conversations. And the result for me, at least, has been actually clients willing to pay more.
Right.
Once they because they're asking those questions, so I get to have those conversations.
Right.
Because some people don't even care.
Right.
Most people do not care.
Yeah.
But the ones that do care, it's always a good time to. It's a very enjoyable thing. I love talking about it.
Yeah.
If you can't tell, I just spent 3 minutes doing it.
Anyway.
Anyways, so, Mark, let's talk about this for a second. I think our relationship started when you said, Matt, you can send me some of your really bad credit score people, and I said,
I had that conversation.
You did. You said, Matt, if they have a credit score of like 560,
580.
I can 580. I can fix them.
Yeah.
You were like
the fixer.
You were the bad boyfriend, real bad boyfriend mortgage guy.
Yeah.
Right. Bad girlfriend mortgage. I can fix her. We don't take both sides here. But I've always seen you as somebody who I can send to, and you're able to very efficiently and thoroughly get somebody set up for a good loan. Okay.
Yeah.
So tell us a little bit about, as a maybe a first time home buyer or somebody who's looking getting back in the market, who hasn't been in the market for some time. How can they set themselves up for success?
I think, what you said as far as like having those, when you're dealing with sellers, and that whole thing that changed was telling buyers, paying buyers agents, things like that. Same thing up front with us is that having the good conversation with and explaining the whole process. A lot of times it's like, oh, I went online and got pre-approved, right?
Mm-hmm.
And they're just like, whether it be through an online lender or whoever it is, but they don't know the whole process of like, hey, here's the expectation. Yes, you do have to pay closing costs. We deal a lot with VA clients around here. I mean, probably 60, 70% of what I do is VA. A lot of them think like, oh, I don't have to have any money out of pocket, nothing like that. It's 100% financing and we can roll the closing costs in those type. I mean, those conversations are more than you would expect. And it was like, yeah, you can't just roll it in.
Of a funding fee.
Yeah, you got those things. I mean, that can be rolled in, but that's the rest of the closing costs you have to. But that being said, with the clients is number one, making them feel comfortable. You said it can be an overwhelming process, but just making it as easy as possible.
Okay.
And presenting them with all the options that's there. Because some people we don't get paid any more or less on what we like. It's like, if you do FHA, conventional VA, USDA, my job is to present to you that here are the best options for you. Here's what you qualify for and what you don't. And, if you down payment assistance programs, here's the pros and cons. So that way they have just a really good view of like, all right, here's what to expect. Here's what I need to do. If it's from credit standpoint, we're not credit experts, but we've been in the business long enough to know, hey, we can look at your credit report and we can tell you a few things here. Hey, if you want to bring it up, like if you do have the 560, let's get it above 580. Let's see let's not just say no, we'll talk to you in a year.
Mm-hmm.
Hey, you know what? If you do these couple things, let's talk in 3 months and you'll be there. And let's keep the contact and the communication open. So that's kind of it. A lot of people just don't have that relationship with a lender. And I feel like that's important, is to build that relationship. So it's not like, oh, you're just a name on a piece of paper to somebody. I'll say with like, sometimes they say with online lenders, like you're just a number that comes through. For us, I always tell them like, hey, if I do something wrong, you know where to find me. You can just come right on Wheeler Road in the office and I can't hide from you or your realtor. So
I'm going to give you your address.
Yeah. I mean, actually my home, I know you do know where I live.
Yeah.
So
Yeah.
just make sure it's James's address.
That's right.
So, yeah. So,
well, I tell you, you're mentioning looking at the credit report and that, we can increase your scores. I mean, it's not only just if you're a 580 and trying to increase it, you could be right on the bubble of going from a 680 to a 700 and get a better interest rate.
Super easy.
So it's something we do across the board for every client. It could be something as simple of paying down your credit card balance that you already have in your account, or you may have already done it, and it's just a matter of updating the credit bureau to what your score is, and if that betters you for your interest rate or your overall payment, I mean it's a big thing. So.
Okay, I love it. Guys, thank you. We're going to get you out on one last question, and it's a question we ask every one of our guests at the end of the show. What is something that you are just absolutely pumped for here in Augusta in the next 12 months? And we can edit this too, so we can, if you need a second to think. I probably should have told you before we showed up to the studio.
Probably should have watched one of your podcasts prior to this.
Yeah, you should have.
Pumped for here in Augusta.
Give me some next 12 months. The mortgage industry, the real estate industry, Augusta in general. 12 months. What's something we're just looking forward to? What are we just absolutely jazzed about?
Really psyched in my mind.
I really think rates are going to come down. I think that we may not get a full point between now and the next 12 months, but I think we're going to be pretty darn close. And it's really, one thing I'll share with you, I tell every consumer, hey, you're shopping for a mortgage. I want you to get the best deal for your family.
Mm-hmm.
We could talk about rates, and rates right now, when you're buying, hey, I'm out looking at properties. You want to talk about rates right now, and you're comparing lender to lender, and we encourage that. I can't say that for everybody, but I'll encourage folks, keep it local and encourage you to shop it. And if we're looking at today's rate, that's great. But, looking at the expertise and what we're trying to do, and I can't say everybody does it because I don't know, is that it does matter what the rate is right now, but it also matters what the rate is when you're closing. And what I mean by that is if I'm trying to time the market and I'm trying to watch it for you and in your best interest, or lock it in and renegotiate and lower your rate, that's on us, and that's for what you should be as a lender. And I mean, we're financial advisors, if you will. We're not licensed financial advisors, but we're trying to give them the best advice for their future in those rates. I just think you should align yourself with folks that are looking at your best interest and giving you advice, and not just locking you because you're comfortable with the payment doing that, but also looking at the rates, telling you what you should look at. But I think that rates are going to lower. I think calls are going to pick up on housing. I think housing is going to pick up. You're going to get folks that are in those 4% interest rates that are willing to go list their house and buy another house, because someone's always going to get married, someone's always going to get divorced, someone's always going to have a child, someone's always going to move for a job. And housing's going to move the way it's always been. And so ultimately, I think that what punts me is knowing that, we're with a great company. We've got great products. We keep our servicing. You're dealing with us through the life of your loan. And, it's a relationship. It's not a transaction, if that makes sense.
Yep. So James is pumped about Movement Mortgage.
He's pumped about I can feel
us
it.
Loving and valuing people the way we
I can feel
I think
it.
my whole wardrobe now has this logo on it.
I know.
That's a good logo.
It is. It is. So
Y'all kind of branched out a little bit on the logo, actually. I think it's changed a little bit.
We've got
wasn't it like one M and now it's two M's?
Well,
No,
it's
two M's.
It's two M's still there. It's
Okay.
like one M that's two M's, but
And an arrow up.
yeah. But we have a bunch of different hats. So
gosh,
I'll tell you right now.
that's so
I know. I got a nice little line there.
Yeah.
I'll tell you what I'm pumped
The hat
about.
stays on during the podcast.
I'm pumped about our swag. Yeah. No, it's it is really toy like a toiga right there. I love the growth.
You're getting really grizzly on that
I
one
know,
right there.
I know. Like-
Jesus.
It was like an Austin
Almost
Powers
like he
thing.
has a top hat on, or it's
Did it-
about to pop off.
Good day.
Yeah.
Can you lock in a rate, please?
Was that?
I don't know what that was.
British,
Cockney.
English,
Yeah, something.
like Australian, a little bit of
terrible.
both. I mean,
Nah.
I like the effort. You went
That's
after
right.
it.
I went
That's-
out there.
Yeah,
It's on tape.
I'd say growth. I love growth in Augusta. And I don't know if anybody wants to hear what I'm talking about. I was actually trying to be serious for a moment.
Get serious for me. We're serious. We're like
It
this.
takes a lot. I mean, I was like blacked out from it. I was like,
Yeah.
growth. Here's what I'm going to
That's supposed to
say.
be the serious one.
I know.
That's crazy.
I don't know. But obviously growing up here, born and raised and everything, it's just, I love seeing how much we've grown as a community. I loved see how Helen, what a tragedy it was, brought our community together. Like a lot of people, like obviously I go to Warren Baptist. So it was just seeing how all that came together and people were there to support, but also the growth of bringing all these new businesses here. We talk about Cyber Command that came here, 5-6 years ago, but it's like now I think the last 4 applications I've taken over the past 2 days were all people coming here for work.
Right.
Mm-hmm.
And it's like, I mean, I don't want it to become a metropolis like Atlanta or anything like that, but at the same time, it's like, okay, they're seeing what a special place this is. I always think it's just one of those where as it grows out, it's good for community. And as long as we keep I always say we're like this, we're in the Bible Belt here, but we're in the small community. It feels like the biggest small town ever.
Mayberry on steroids.
Yeah, it really is. So it's like, what is Augusta? It's a huge city.
It sounds like you like
CSR.
traffic.
I love it. I lived in Atlanta for 2 years,
Yeah.
so I did like traffic.
We have a long way to go.
Yeah, we do have a long way to go.
That traffic.
But it's
I don't
cool.
want to go there.
No, but that's it. I mean, I don't know. I love seeing people come in and just, building those relationships. And That's just cool to me. I'm a people person, so I can talk to anybody.
Y'all, thank you so much, Mark, James. I do appreciate it. Thank you for coming on and sharing your expertise. We brought you out here for a reason. For Movement Mortgage. If I want to contact you about a mortgage, about a refinance, how could I do so? Mark, I'll start with you.
That's a cell phone call. Call me.
What's the cell phone number?
My cell phone number is 706-825-8334.
Perfect. James?
JamesGay.com or 803-215-2412.
I love it. Guys, thank you very much.
Thank you.